Chapter. We're talking real money.
There's one thing that eventually all of us want from our investments. Well, generally we want that. Okay, I'm not doing that today. One thing that we want from our investments at some point is an income. We want them to provide us with at least a portion of the money we need to survive once we're no longer working. And for that, we think about the various places that have fixed income. Bonds are probably the primary source of fixed income investing. CDs, there are some other things, but generally speaking, bonds are the number one vehicle for creating income, at least in the minds of most people. Now, we're going to differ with that in some ways, but here's the thing. As interest rates rise and fall, people react to those, and they want to change their investments to optimize income. And this can be a dangerous strategy and a direction that really could cause you some serious harm longer term.
I think the expression is more money's been lost, what they call reaching for yield, than at the end of a gun. In other words, people trying to make a little bit more on those instruments that they should be using for stability and losing it because they're taking risks they didn't understand with those, right?
And there's so much bad advice out there on the internet and on the radio and on TV shows.
And in fund
print.
Management.
Yeah, where people are telling you there are magical ways to increase the income stream from your money. And they're often saying, adding these words, which are the scariest words anyone can utter, with no risk.
Yeah, and that's the problem. For decades, we have suggested a couple things when it comes to fixed income. First of all, not to view it in comparison to your stocks because the returns should be less because there's a guaranteed nature.
There's less risk.
It's an IOU. There's somebody's going to pay you back. Here's the interest. Versus stocks are simply investment. They're equity, right? They're investment in companies. Could go up, could go down.
You're hoping that company becomes more valuable, but there is no backing except the assets of that company.
Exactly. And the potential growth, et cetera, et cetera. But people have a tendency to compare them. That's a mistake. People also have a tendency to believe that someone managing this can do better than just owning the thing that we have suggested for decades, an index fund. You just own a lot of these securities.
All you have to do is ask almost any mutual fund manager who manages a bond fund, and they will tell you they're smarter than you are. Heck, Bill Gross used to even say he was smarter than the Federal Reserve.
He used to tell them, hey, you really should be doing this.
I know.
This. You're making me mad. Okay, well, sorry, we're the Federal Reserve.
Bill Gross was, by the way, a famous...
Well, he was the bond king, I believe, at one time.
I'm thinking maybe that was a marketing moniker.
And a good one it was.
Because I don't know that he was, he had some luck, yes.
But, let's not go there. But at any rate, let's talk about sort of how to invest in bond funds. We still think that you should use a fund. You could use an exchange-traded fund or a mutual fund. And today, it's about 60% of the money that's managed with stocks is in a passive index-style portfolio. But it's the opposite when it comes to bond funds. It's about 60% of the money in bond funds is actively managed. In other words, they have a manager. They're going to tell you, this looks better. I'm going to move the money here because here's what's going to happen with interest rates, which, of course, they were wrong about for like 5 years recently, right? Every year they said rates have to
go up.
Yeah. And they were wrong. It didn't happen year after year after year. So what do we care about all this? Well, here's the reason we care. And especially now, because I'm really nervous about what people are going to be telling you in the years ahead if interest rates go down. Because if rates go down and you're only making 3% on your bond fund, you're going to say, wait, there's somebody smarter that's going to make me more than that.
Okay, hang on. If you are in a bond fund today, this is one of the things about funds. We poo-poo funds, but funds are a very, very valuable method of investing in bonds. Because if you buy an indexed bond fund, then you are in essence getting a portfolio of bonds that will hold, many of which will hold their yield even if rates are currently moving lower, because they were purchased when rates were higher. So a bond fund works to mitigate some of that volatility of owning just shorter term maturities or a cash account, for example, like a savings account.
But listen to some of these numbers now, and we're going to pick on PIMCO. I know PIMCO is a very popular active manager of bonds. That was where the aforementioned Bond King used to reside, or should I say rule. The PIMCO Income Fund, PIMIX, which is the largest active bond fund with $166 billion in assets. Listen to this. 19.3% of that fund is in high yield and emerging markets. So 1 out of every $5 is invested in bonds that are, you got to figure, pretty risky. High yield is a euphemism for junk, right? Not it's, and emerging markets. Well, those are those places that, some days they could pay you back, and then the next day they may run out of cash. They're riskier. They're paying more. Then there's the PGIM Total Return Bond Fund, the 7th largest, 23% of its assets in bank loans and collateralized loan obligations, and then another 10% in high yield and emerging market debt. Again, making bets on what the future will look like so that you can make more in bonds. That's the risk I'm talking about that really concerns me.
Yeah, and you didn't mention right now in fact, let me look it up. Let's look up the BND yield. BND.
Which is, I'm going to guess,
the Vanguard
3.8, 3.9, maybe something like that.
Vanguard Bond Index yield is 30-day SEC yield is running 4.4.
Wow. I mean, that's pretty good.
Well, unless you look at the yield of the PIMCO Income Institute, the PIMIX.
Yes, how much?
6.19.
Yeah, right. And this is the argument that people are making. Like, well, I'll move it there and I'll make more money, not equivocating the fact that there's an additional amount of risk to that, correct?
A great deal of additional, and it's not just volatility risk. It's inherent loss risk. See, in the Vanguard portfolio, the quality is pretty darned high. And that's our concern. It's not the volatility, because they're both going to have similar volatility because they both react to interest rates. So the volatility really isn't our concern. But in the Vanguard Total Bond Index Fund, there are no junk bonds. No junk bonds.
No high yield.
It's all higher, triple B or better. And by the way, 72% of the portfolio consists of AAA rated bonds. The highest rate, higher than the U.S. government's rating. I know,
which is kind of shocking. I looked up last night. You know what the prevailing interest rate on high yield bonds is right now? The average?
No.
7.1. How about emerging markets bonds?
Ooh.
6.5. I mean, so do you think there's an equivalent amount of risk in those? That has to be, right? Because people are willing. That's how much they got to pay them in interest to buy their fixed income. And it's something, again, that I think people forget. They just look and say, I'll take the one that's paying more. This is what I run into a lot. I like that one because it's going to give me more money. Again, not realizing that it's reaching for those extra returns that requires taking on more risk, right?
Mm-hmm. And Vanguard, by the way, their high yield corporate fund, VWEAX, is let's see here, about 85% in junk bonds. Junk. Wow. Below investment grade. No, it's almost 90%.
I think that's the one that lost 25% of its value in 2008 and early 2009. That's not very bond-like to me. It really scares me because when that happens, and the worst, guess what? The longer duration bonds got hit harder in 2022 as well. And this is what these people are doing here, is they're extending out that duration to get a little more yield if they can find it somewhere. And they're taking more risk to do it as well. And so what do you do with that information? Oh, you're still trying to find the
Yeah, let's see. 2008.
Their I believe their high yield corporate.
You're right. High yield lost over 25%.
Yeah, that's not
over
very
20,
bond-like.
That's stock-like losses.
Yeah, exactly. And people forget. Oh, that was a long time ago. That couldn't happen again. Well, sure it could. It could happen again. 2020.
Well, hold on. You want to talk about it happening again? In 2021. The value fell
or 2022?
by 2021 through 2022 for that 1 year.
Yeah.
The value fell by about 20%.
Yeah. So it has happened. Could it happen again? It could happen again. Again, and this is something we've talked about a lot. Keep your maturities relatively short, your quality high. Use index funds because low cost means a lot when you're only making 4% yield. And don't look at these as a method of creating income to me or growth. Look at them for stability in your portfolio. That's what you're looking for.
And okay, thank you for bringing that up. I want to make this point again. We have looked at the numbers over and over and over again. And a lot of other really smart folks have done the exact same thing. And over and over and over again, running all kinds of simulations, also looking at real numbers over long periods of time. You generally would have been better off.
No.
Yes.
Okay.
You generally would have been better off taking the total return from your portfolio, taking a piece of the total return. In other words, not relying just on the income, but using rebalancing to take a little money out of your stocks once in a while too. Versus active. It's a study they do twice a year. And they find that most managers underperform their indexes over longer periods of time. And I tell you, with stocks, the numbers are huge. But some will argue that fixed income, it's different. No, it's not. General government bond funds that are managed lose out 100% of the time over a decade to index
100% of the time.
100%.
That's pretty consistent. Wow.
The percentage of funds that underperform the index over 10 years is 100%.
Need convincing? 100.
General investment grade bond funds, 15% of those. 14% of those outperform the index over a 10-year period.
Just got to buy them ahead of time. Know which ones those are.
Which ones it was, because
they'll tell you.
After the fact, you won't know.
No, will they tell you ahead of time so you can just go ahead and run out and buy those?
No, they'll tell you what they've done in the past.
Okay.
And then imply that means something about the future, which it does not.
No, it doesn't. So,
all right,
thank you.
Question time.
Great advice. Yeah, okay. Brian from Renton, Washington. My wife and I attended and enjoyed Retire Meet last year. There's a multi-part question, by the way. How will the information in the upcoming Retire Meet differ from last year? Well, first of all, we've added in a session.
The same.
We added in a session on crypto. We added in.
I forgot the gold session.
I didn't tell you about these things,
the
right?
Real estate,
emerging market debt, opportunities,
private real estate placement.
Oh yeah,
things.
I got some Argentinian 99-year bonds. I'm going to unload in the back of the room at the middle part of. Okay,
Indexed
we're kidding.
Annuities.
You give me a bad time for teasing. There's a few things that are different. We have Joe Saul Seahigh coming, good speaker. Great speaker. Interesting topic. We have Roxy Butner coming to talk about, fixing up the next generation. Don thinks it's babies. I think it's probably Gen Z, X, Y, whatever it is. I don't know what those young people call themselves anymore. So there's other stuff. Apollo Pescu always has an update. It's a little different every year, but is the messaging a lot different? Don and I are going to deliver this. We've been delivering a similar message for a long time.
I'm trying to mix mine up. I mean, last year I did the history.
That's right.
Of investing.
That was very good. I love that one.
So I don't know. I may mix it up. I'm telling you, my session's going to be something different.
You're going to have two slides and just get up and chat for 35 minutes.
Probably.
Yeah.
Anyway.
Right. So it's a little different, but you can learn more by going to retiremeet.com. Find out all about it.
And by the way, nothing wrong with a refresher.
Well, you don't go to church once, right? You go more than once.
Right.
It's religion.
Our church is only held once a year.
It's really, I guess.
And they serve, and we serve sandwiches.
Okay.
I mean, when you go to church, you're lucky to get that wafer.
You're starving. Little offer.
We're going to get you sandwiches and breakfast.
Wait, that's a good point. All right. So Retire Me, check it out. Thanks, Brian. All right. Then the meat of the question. We'd like to establish a 529 for our 8-month-old granddaughter. Congratulations. That's awesome. And make regular contributions every Christmas and birthday. By the way, I do this for my grandkids. And I got another one coming. Did you know you can open a 529 for a grandchild that's not even born yet?
Yeah, you told me that. I was surprised. Cool. They're not even here yet. We don't even know what they are. They may not have great prospects. Who knows?
That's true. Oh, this is my family we're talking about here. Of course she'll have great prospects.
Of course they have great prospects.
Coverdell's, which are another option for saving for college, are not an option for us, according to Brian, due to our income. Here's the question. Will you please compare and contrast? This is like a study guide or something. Compare and contrast.
This has got to be a teacher.
Sounds like it, doesn't it? Education 529 plans offered by, and then not necessarily in this order, Don, Vanguard, Fidelity, and Charles Schwab.
They're all fine. There you go.
I believe Vanguard uses the state of Nevada. Yes, I think that's correct. Fidelity's website mentioned a unique college investing plan through New Hampshire. Not sure the details of Schwab. We currently have retirement accounts at both Vanguard and Fidelity, have not used Schwab. So if I had retirement accounts at one place, that would be one. Number two, I would use...
it's about ease of use more than anything.
Exactly. I would use the age-based programs. They're very good.
Yep.
They move into more bonds as the kids... In fact, I keep meaning to look at what my 16-year-olds looks like now. But the age-based, you can find low-fee, widely diversified, good index products, I think, at all three of those now,
At all
right?
three of them.
Yeah.
Yep. You absolutely have great choices at all of them. And the expense ratios have fallen in line pretty much across the country. They're within fractions of a percent of
15 years ago, whole different deal.
So,
but now
it's more about convenience than anything, I think.
I agree.
So wherever it is you work there.
Yeah. I've got a couple of them in different places. I should clean that up. All right. So, Brian, we hope we get to see you again on February 8th for Retirement 2025. All right. This one's a little trickier. Comes from Lynn in Orange, California. I'm retired, age 70, from a long career as a software developer, then corporate executive. I'm taking CFP courses, Certified Financial Planner courses, with the goal of being an analyst. No need to climb a corporate ladder. My strength is execution and communication. In addition to passing the CFP, are there additional licenses and credentials required? I may even look for a mentor soon if someone will have me. So kind of somebody wants to get in the business pretty late in life. Not that 70 is old, but it's kind of old. And then when you say analyst, that worries me.
Yeah,
because
that was the words that threw me too.
Yeah, does that mean you're going to analyze things?
I'm thinking if you just want to analyze and you're not wanting, CFPs work with clients.
They don't analyze a lot other than plans.
Their job is, as a matter of fact, what you probably need is the CFA program.
If you want to be an analyst, yeah.
Which is the Chartered Financial Analyst. Because it sounds to me like the CFP would not, because basically the CFP curriculum is about client-facing issues.
Sitting down with people, talking about their plan that we mentioned, their asset allocation that we mentioned, their tax situation, all those. And by the way, interestingly enough, the number of people getting the CFA keeps going down.
Right.
The number of people getting the CFP keeps going
up.
Like
crazy.
Yeah. So because
there are less than 250,000 CFAs.
Yeah.
I don't know how many CFPs are out there, but the CFA program is specifically designed to teach you how to analyze investments.
Which might be a good job for somebody that wants to work a little bit, wants to work from home. Being a CFA, you could probably do that from a desk somewhere remote. It wouldn't matter. You could analyze whatever the company needs you to analyze. So there really wouldn't be any additional licenses or credentials there. But if you're going to help clients, then yes, in addition to the CFP, you need what's called a Series 65, which would be a very easy test after the CFP.
Either.
It's again, because then you got to be registered, all that. Here's what I would do.
A CFA doesn't have to be registered.
No, I'm talking about the CFP.
Yeah. That's what I'm saying. CFA doesn't.
Yeah, you can do anything you like. If you want to give advice to people, so this gets back, Lynn, to really what you're asking. Are you asking to get in the business of sitting down with people, as Don said, and helping them? Or do you want to be sitting back and analyzing why it makes more sense to own Tesla than NVIDIA, right? That's what a CFA is going to do, or analyze a company, et cetera, et cetera. Two different things. You got to make that decision first. And then before I even got further, I would do what you mentioned at the end. I'd find a mentor who's going to tell me, here's what the opportunities are, because I think it's going to be harder to get in this business again, not that you're old at 70 because we're getting closer, but we're already in it. So, but if you and I had to run out and find another job right now, Don, it might be hard to do. I don't know. A lot of companies are going to say, hiring Bill Belichick. I mean, like, how old do you want how many years you got ahead of you?
I'm getting to the point where, for example, if I wanted to go become a CFA, that's a 3-year program. Yeah. That's worse than an MBA.
Mm-hmm. And a lot of work. I mean,
a lot of work.
It's
cheaper than an MBA. A lot cheaper.
Is it? Okay. And I'm assuming in today's world, you can basically do it all online. I'm assuming.
Do it all online, yeah.
Okay. So, but those would be the things to think about, Lynn. And you can always reach out to us, to me. I'll be glad to talk to you about making a decision between these things and trying to give you some advice about all this. And we have an office right there in sunny Southern California that might be willing to talk to you as well. I don't know.
Well, thanks for the questions. And if you want to send in more, just go to talkingrealmoney.com. Talkingrealmoney.com. Click on the Contact Us button and either type your question, which everybody for some reason does, or speak them like you used to do when you talk to people on the phone. You remember those days? Talking on the phone?
I still enjoy it.
People on the phone, like your voice. I don't know what it is, but all of my kids hate talking. They'd rather type.
They don't want to be interrupted by having to actually get on the phone and talk to somebody. That's a major interruption.
It was so funny. Before we started recording, I was downstairs with Debbie, and she's going, my phone just keeps ringing, and people are texting, and I just need to take a break from all this. And I said, watch this. Beep. Siri, turn on Do Not Disturb. I just turned on everybody's Do Not Disturb around America now.
I thought of that.
She goes, you can do that?
Yeah.
I said, yeah. And then just tell her when you want to turn it back on.
Yeah. Well, if you remember how,
you just say the same thing in reverse.
I think I turned mine off once and couldn't figure out how to turn it back on. So that's fine.
Tom,
I know. It's fine. No, I'd rather have it this way anyway, frankly.
I don't know that you all know this, but I'm gonna come clean on something. I'm gonna share something.
Wait, you're gonna come clean on something on me, you mean?
Kind of. Yeah. I actually, it turns out that I married and work with basically the same person.
That's very close to being true.
Basically the same person.
I feel bad for you.
Their personalities are almost identical. And so...
So what, do you want a medal now or something?
Yes,
or what do you want?
I want a medal.
You want a presidential award of some kind, a receipt?
I want some sort of recognition for all I've gone through.
Maybe at the gates, they'll be waiting for you and give you a big pat on the back and send you to the right place.
Look,
so
you did it.
You made it, man.
Congratulations. That makes up for all the bad things you've done.
It's going to be close, but we'll see if we can skinny
everybody,
by.
Thanks for being a part of the program. Please tell somebody you like it, even if you don't. If you don't like it, just tell them you do. Be charitable this time of year.
Exactly.
As a Christmas gift. Give us new listeners. That's all we want all I want for Christmas is some listeners.
Pretty good. Yeah.
Okay.
That'll work. Thanks for joining us.
We're going to be back soon, though. Talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit talkingrealmoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.